All right, so you're here with us on the deep dive because you're the kind of person who loves to cut through all the hype
Yeah.
and get to the core of complex topics.
Yeah.
And, well, today we're diving into a really fascinating one.
Absolutely.
Can we really predict what's going to happen in the stock market?
Yeah.
It's like the holy grail, right?
Oh, yeah. Everyone wants to know.
Everyone wants to know from, people who are just starting out with investing
Hmm.
to like the most seasoned Wall Street, veterans. Everybody wants a piece of that.
Yeah. If it were easy, we'd all be rich.
Exactly right.
Uh,
If we knew exactly what the market was going to do, we'd all be on a beach somewhere.
exactly.
But it's clearly not that simple. So to try and at least get a little bit closer to understanding this,
Right.
we've been digging into some pretty cool stuff. A research paper called a novel ensemble deep learning model for stock prediction based on stock prices and news.
Oh, wow. That's a mouthful.
It is. It's a long title, but don't worry, we'll break it down. And we've also got some real-world stock market data to kind of give us a feel for the numbers behind all this.
Mm-hmm.
So our mission today is to figure out how are these advanced computer techniques, this deep learning thing,
Right.
how are they being used to try and forecast, where the market's headed?
Yeah.
And we want to do this without getting too bogged down in all the super technical stuff.
Okay. I like it.
Just the good stuff.
The core insights.
Exactly, the core insights. So let's jump right in. What makes stock prediction such a tough nut to crack?
Well, it's like, you said it's like trying to predict the weather,
Mhm.
but even more unpredictable.
Oh, yeah.
The paper does a nice job of breaking down these factors that influence the market. And I think the first thing is company-specific news and information.
Right.
So this could be anything from their earnings reports, new products they launch, management changes, anything that can affect the perceived value of a company.
Right.
And we see this all the time. Like when a company like Tesla announces a breakthrough in battery technology,
Yeah.
their stock price often goes up.
Goes through the roof.
Exactly.
Or think about a company that gets hit by a scandal or some bad news.
Right.
People lose confidence, their stock price plummets.
Exactly. It's like the classic example of supply and demand.
Right.
If there's good news about a company, there's more demand to buy the stock.
Mm-hmm.
The price goes up. If there's bad news, more people want to sell.
Right.
Price goes down. It's that simple. But it's not always so straightforward, right?
It's not just about individual companies, though.
Oh, absolutely not.
It's a whole ecosystem.
Exactly. The performance of the entire industry matters a lot.
Right.
Like if the energy sector's doing well,
Mm-hmm.
even a stable oil company might see its stock price rise.
Mm-hmm.
And then there's this whole thing about investor sentiment.
Or the psychology of the market.
Exactly. Are people feeling optimistic? Are they buying? Are they bullish?
Right.
Or are they fearful and selling? Are we in a bear market?
Right.
This collective psychology, it can really drive prices up or down, sometimes even irrationally. And let's not forget the big picture.
Right.
The macroeconomic factors like interest rate changes, inflation numbers, global events, war pandemics, all of that can have a huge impact on the market.
Right. It's this constant deluge of information.
Yeah, it's overwhelming.
Right. And then on top of all of that, the paper talks about this concept of the historical window size,
Yeah.
which is kind of like how much past data do we need to consider
Right.
to try and make a prediction? And it makes sense, right?
It does.
I mean, like we as humans can only process so much.
We have limited memory.
Yeah, we've got limited memory, limited attention spans.
Yeah.
If you try to analyze like years and years and years of historical data,
Mm-hmm.
some of it might be outdated and completely irrelevant to what's happening now.
Absolutely.
But then on the other hand, if you only look at like the last week or two,
Mm-hmm.
you might miss some important long-term trends or those, delayed reactions to major events.
Right.
So
yeah.
finding that right balance.
Yeah, the sweet spot.
Yeah, the sweet spot, that's tricky. And that kind of brings us to why I think a lot of the older computer-based prediction methods
Mm-hmm.
haven't really been that successful.
Right.
It seems like they often focused on just one type of data, like, either analyzing news headlines or crunching stock prices, but not really both together in a really sophisticated way.
Yeah, that's one of the key limitations that this paper addresses.
Mm-hmm.
And, if you only look at sentiment analysis of news articles, for example,
Mm-hmm.
without considering the historical price movements,
Right.
you're only getting part of the picture.
You're missing half the story.
Exactly. And on the other hand, just looking at past price charts might completely ignore those crucial real-world events that are actually driving those price changes.
So looking at the symptom, but not the cause.
Exactly. So this research is saying we need to connect these two worlds, the textual data from the news and the numerical data from stock prices,
Okay.
and understand how they evolve over time. And that's where this paper gets really interesting.
Okay, so this is where they introduce this new approach, this blending ensemble deep learning model, which sounds super complicated.
Yeah.
So break it down for us.
Okay, so let's start with ensemble learning.
Okay.
It's like, imagine you're trying to make a big decision. Instead of just relying on one person's opinion,
Yeah.
you get advice from a group of experts,
Right.
each with their own strengths and weaknesses.
Diverse perspectives.
Exactly. In AI, ensemble learning works in a similar way. You train multiple submodels,
Oh, okay.
each looking at the data from a different angle, and then you combine their predictions.
So it's like they're all voting on the outcome.
Yeah, it's like a wisdom of the crowds thing, but with algorithms.
Okay. I like it. So this blending ensemble model.
Right.
It's got a specific structure, right?
Yeah, it's got a two-level design.
Okay.
At the first level, they use two types of recurrent neural networks,
Okay.
which are LSTMs and GRUs.
Okay. So first of all, what's a recurrent neural network?
So RNNs are a type of neural network that's really good at handling time series data, like stock prices, because they can remember information from previous steps in the sequence.
Oh, so it's like it can remember yesterday's price and the price the day before.
Exactly, and all the previous days.
And see if there's any kind of pattern emerging.
Right, like a mental notepad that keeps track of what it has seen before.
Okay, that makes sense. So LSTMs and GRUs,
Right.
those are specific types of RNNs.
They are.
And why are they special?
So traditional RNNs can sometimes have trouble remembering information from way back in the sequence.
Okay.
So, that notepad might get a little fuzzy.
Right, the memory fades.
Exactly. But LSTMs and GRUs, they have these special mechanisms that allow them to selectively remember or forget information.
Oh, so they can hold on to the important stuff?
Exactly. It's like highlighting the key points on your notepad.
Okay.
Discarding the irrelevant stuff so they can learn from much longer sequences of data.
So like upgraded notepads.
Yeah.
Got it. So are LSTMs and GRUs like interchangeable?
Well, they both have their strengths and weaknesses.
Okay.
And that's actually a key part of this blending strategy. So sometimes LSTMs might be better at picking up certain patterns in the data, while GRUs might be better at other patterns.
Right.
So by using both of them, they're capturing a wider range of potential signals.
Oh, so it's like having two different analysts.
Exactly. Two different perspectives on the same data.
Okay, so level 1 gives you two sets of predictions.
Right.
What happens in level 2?
So level 2 uses what's called a fully connected neural network.
Okay.
And this network takes the predictions from the LSTM and the GRU as input and learns the best way to combine them.
Oh, so it figures out
Yeah.
which one to weigh more heavily.
Exactly. It's like a master conductor
Yeah.
orchestrating the final prediction.
That's really cool. And so they also factor in news sentiment,
Yes.
which seems really crucial. So how do they bring those headlines into this model?
So they use something called sentiment analysis on headlines from 4 major financial news outlets.
Okay, which ones?
CNBC, Reuters, The Wall Street Journal, and Fortune.
Oh, the big players.
Exactly. And they use a specific tool called Vader,
Okay.
which gives each headline a score from -1 to +1.
Okay.
So basically, how positive or negative is the news?
Right, right. So they only use the headlines, though,
Yeah,
not the full articles.
that's right.
Was there a reason for that?
So they actually reference other studies that suggest headlines often capture the main sentiment
Right.
and can be less noisy for a model to process.
Okay, less fluff.
Exactly. It's like getting to the point.
Right, to the point. Okay, so they've got these sentiment scores.
Mhm.
They've got the SP 500 historical prices.
Yeah.
What time period did they look at?
Their data set covered from December 2017 to June 2018,
Okay.
and they focused on the adjusted closing price of the S&P 500,
Right.
which takes into account things like dividends and stock splits to give a more accurate picture of performance.
Okay, and how do they get this data ready to feed into the model?
Well, there's a lot of pre-processing involved. You
Wow.
can't just dump raw data into an AI. First, they had to clean up the data, removing any missing values. Then they matched the news sentiment scores with the stock price data based on the date.
Okay.
Then, because the stock market's closed on weekends,
Right.
they excluded those days.
Right.
And then they divided the data into 3 sets.
Okay.
A training set, a validation set, and a test set.
Okay, and what are those for?
So the training set is used to teach the model the patterns.
Right.
The validation set is used to fine-tune the model's parameters.
There you go.
And the test set is used to evaluate how well the model performs on completely new data.
Oh, okay, like a final exam.
Exactly. So the training period was from December 2017 to early April 2018. The validation was mid-April to early May 2018.
Okay.
And the testing was in late May 2018.
Got it. You mentioned earlier this rolling window of 10 days.
Yes.
What's the idea behind that?
So imagine you're trying to predict tomorrow's stock price.
Mm-hmm.
A rolling window of 10 days means the model looks at the news sentiment and stock prices
Okay.
from the past 10 trading days to make that prediction.
Okay.
And then for the next day's prediction, it rolls the window forward by 1 day.
Right.
So it's now looking at the 10 days leading up to today.
Right.
And this creates a sequence of data points over time,
Right.
which is exactly what RNNs like LSTMs and GRUs are good at learning from.
Okay, so it's like it's constantly updating its knowledge.
Exactly. It's a moving window of data.
Got it. So they built this model, they prepped the data.
Right.
Now, how did they measure if this whole thing actually worked?
So they used a few different metrics to evaluate the model's performance.
Oh.
One was mean squared error, or MSE,
Okay.
which basically tells you how close the model's predictions were to the actual stock prices.
Right. The lower the better.
Exactly. Lower MSE means better accuracy.
Okay.
They also use precision recall and F1 score, which measure how well the model correctly identifies when the stock price will go up or down. And then there's mean prediction accuracy, or MPA,
Right.
which looks at the average percentage difference between the predicted price and the actual price. And finally, a really important one for investors.
Okay.
Movement direction accuracy, or MDA, which tells you what percentage of the time the model correctly predicted whether the stock price would go up or down.
Right, regardless of the exact amount.
Exactly, just the direction.
Okay, so did this fancy blended ensemble model actually do better than other methods?
The results were pretty impressive.
Okay.
The blending ensemble model did outperform the other models they tested.
Okay.
Which included just using an LSTM alone, a different type of LSTM called DP-LSTM, a GRU alone, and some simpler ensemble methods.
Right.
And it consistently performed well across most of those evaluation metrics.
Okay, so it was a clear winner.
It seems so.
And they specifically highlighted a significant improvement in MSE
Yes.
compared to just the basic LSTM.
Exactly. They saw a big reduction in mean squared error, suggesting that this blending approach was much better at predicting the actual price levels compared to just the LSTM.
So more accurate predictions?
Yes. And they also saw improvements in precision recall and F1 score, showing that it was better at correctly classifying up or down movements.
Got it. And what about that MDA, the movement direction accuracy?
So the blending model achieved an MDA of around 66.67%.
66.67%.
Okay. Which is pretty interesting because the paper actually cited other research suggesting that even 60% accuracy in predicting stock movement can be enough for profitable investment strategies.
Wow. So being right 2/3 of the time could potentially lead to some serious gains.
Potentially. And they included some graphs in the paper showing how the blending model's predictions more closely followed the real stock prices.
Oh, so you could visually see
that
it was doing a better job.
Exactly. It aligned more closely with the actual market movements.
Okay, so the researchers seem pretty convinced that this blending method is a real step forward.
Right.
What are some of the bigger implications of this? Like, who could actually use this kind of model?
Well, this research is really exciting for anyone interested in stock market prediction. It has potential implications for investment firms, hedge funds, even individual investors who are looking for more sophisticated tools to help them make better decisions.
So it's not just some theoretical exercise.
No, it has real-world applicability.
And like any good research paper, they talked about some future directions.
Right.
Where do we go from here?
Yeah, they outlined a lot of interesting avenues.
Okay.
One is hyperparameter tuning, which is basically like fine-tuning the model settings to see if they can get even better performance.
Okay.
They also suggested using much larger data sets, potentially incorporating things like detailed company reports, 10K filings, things like that.
Right, so even more information.
Exactly. And another interesting area is trying to understand why the model makes the predictions it does.
Oh, that's interesting, like peering into the black box.
Yeah, exactly. Maybe by extracting rules or identifying patterns
Right.
so we can interpret the model's decision-making process.
Right, so it's not just magic.
Exactly. We want to understand the reasoning behind it.
Okay, and anything else?
Yeah. They also talked about attention mechanisms,
Okay.
which allow the model to focus on the most important parts of the input data.
Mm-hmm.
And they even mention exploring reinforcement learning for that second-level blending model,
Right.
which is a completely different type of AI
Right.
that learns through trial and error.
Oh, so it was like constantly trying to improve his strategy.
Exactly. It's a very dynamic approach. And they also brought up the idea of using fuzzy deep learning.
Fuzzy deep learning. Okay.
Yeah, which can better handle the ambiguity and uncertainty
Right.
often found in news and financial data.
Okay.
And they even talked about dynamically adjusting the historical window size
Okay.
based on the type of news being analyzed.
Well, that's interesting.
Yeah, so recognizing that some news might have a longer lasting impact.
Right, right. So like a major economic announcement might be relevant for weeks or months.
Yeah.
Whereas like a small product update might only matter for a few days.
Right. It's about being sensitive to the context of the information.
Right. It's really acknowledging the complexity of how information flows in the market.
Absolutely.
Now, we also had that datainfo.txt file that we mentioned earlier.
Yeah.
How does that kind of connect to all of this?
So that file gives us a glimpse into the real-world stock market data that these models would be trained and tested on.
Okay.
It had a ton of entries, each representing a day of trading for a specific stock,
Okay.
with information on opening, high, low closing prices.
Okay.
And it highlighted that real-world data often has imperfections, like missing values in some of the price columns, which you need to handle during the data preparation process.
You got to clean it up.
Exactly. And it showed us the range of companies included. Some had data going back many years. Others were more recently listed and had shorter histories.
Right. So the amount of data can vary a lot.
Absolutely. And it also had a field for average trading volume.
Right, right. Average volume.
Exactly. And that's another example of numerical data that could be potentially useful for stock prediction.
So how would that factor in?
Well, volume can indicate how much interest there is in a particular stock.
Okay.
High volume might mean there's strong conviction behind a price move, while low volume might make a price change less significant. So it's another piece of the puzzle.
Yeah, yeah. So basically this data file shows us the raw ingredients that feed these deep learning models.
Exactly.
And the principles from the research paper about using historical prices and news sentiment could be applied to data sets like this.
Absolutely.
With the right pre-processing.
Exactly.
So to wrap things up,
Yeah.
what's the biggest takeaway you think our listeners should remember about using deep learning for stock market prediction?
Well, I think the key point is that these advanced blending ensemble models that combine the signals from news sentiment and historical stock prices have the potential to be much more accurate than traditional prediction methods.
So it's not just hype?
No, the research suggests it's a real step forward.
A step towards that crystal ball.
Maybe not a crystal ball.
Okay, maybe not a crystal ball.
But a more sophisticated way of understanding and forecasting the market.
Right. Because the market will always have an element of unpredictability.
Of course, there are always unknown unknowns, but these tools give us a better chance of navigating that uncertainty.
And that brings us to our final thought for you, our listeners, to ponder, given the crazy speed of AI advancements. In all this financial data that's out there, what other cool approaches might we see in the future?
Yeah, what's next?
What's next, right? It's a really exciting field.
Absolutely.
So if this deep dive has piqued your curiosity,
we
encourage you to check out the research paper we discussed, or even, just start exploring the basics of deep learning and sentiment analysis.
Yeah, there's so much to learn.
There's a ton of resources out there, so keep learning, keep exploring, and we'll catch you on the next deep dive.
Sounds good.